Hello and welcome to our half-year review of the energy markets. We'll be discussing the main major factors impacting why the markets have been rising, also specifically into power, gas, and also our outlook for the future. 2022 has seen unprecedented levels of volatility. Some of the key factors influencing the price over these last few months has been the planned and unplanned maintenance. Obviously, the war in Ukraine has been the major impact this year. The fire at the Freeport LNG facility, Russia sanctioning European energy firms, Russia halting gas supplies to both Poland and Bulgaria. Additionally, the minimum storage regulation, which has been implemented to get storage levels at a certain percentage by October and November every winter. The front month has been extremely volatile over these last 6 months. On this graph, we can see how it has gone from 322 to 503 pence per therm and getting as low as 129 pence per therm, all within these last 6 months, which is unprecedented levels of volatility. Brent crude prices have also seen unprecedented levels of volatility. They have been on a relentless bull run, rising from $80 a barrel right up to $120 a barrel these last 6 months. In terms of basic supply, fundamentals remain tight. With Russian oil being excluded from the global market, other producers around the world are struggling to increase their output to meet global demand. Now to discuss power specifically, if we now look at the power forward curves, we can see the summer 23 contract or April start dates for next year have risen 123% since this January. Here on this graph you can see winter 22 prices have surpassed £342 per megawatt hour, and the rest of the curve has increased exponentially as well. Although the curve remains in backwardation with prices cheaper and cheaper year after year, the reality is these prices have all risen over 120% over these last 6 months, with no sign of relenting whatsoever. Onto our power supply mix. Last year, lack of wind generation was a key driver of why energy prices were rising, which was putting pressure on additional gas demand. However, that gas was in rare supply as well. This year, we've seen wind generation slightly stronger over the last 6 months. In June, wind generation averaged 5 gigawatts, down 16% compared to May. Gas generation, or CCGT, continues to account for a large portion of the UK electricity mix. The high gas price during June continues to impact electricity profitability. Coal generation was slightly evident throughout June, however, it played a minimum role in the generation mix compared to last year. The supply mix for this upcoming winter will be pivotal. Coal power plants are expected to be online this winter, as well as the increasing lifespan of gas power plants, and there are prospects of what can be done for the nuclear power plants as well. Although throughout Europe and globally, bringing back fossil fuels is not the ideal scenario for our net zero goals, it is the only way right now to keep the lights on this winter to ensure we have sufficient supply and avoid any cause of blackouts. On the 1st of August, the EU will be banning Russian coal, putting additional pressure on all other supply sources. The summer 23 gas contract has risen over 170% since the start of January this year. Although the market remains in backwardation, prices have risen exponentially over these last 6 months. This coming winter prices have already reached well over 370 pence per therm. For 2023, prices have all gone over 220 pence per therm, and now in 2024, prices are hovering at 150 pence per therm, compared to 6 months ago, where they were all sub 80 pence per therm. Gas demand averaged 121 MCM for June compared to 115 for June in 2021. So year on year, we are seeing the reduction of gas demand, mainly driven by energy efficiency, but also increased temperatures which have reduced that demand. And gas demand is expected to remain subdued throughout July and for the next few months due to these higher than forecasted temperatures. The real key pressure is what will happen this winter. Will it be like 2019, where from the 1st of October prices declined throughout winter because it was warm? However, last winter, this 2021 one, prices recovered simply because it was a warm winter, which would suggest that this winter would be a lot colder than expected. UK storage is incredibly comfortable at 95% full. It is a complete opposite of what was the case of 2021, when storage was at record low levels. Current storage levels are significantly above the previous 3 years' levels. April, May and June saw significant injection into our storage facilities, taking us to record high levels, giving ample supply for this upcoming winter. However, if the winter is harsh, the UK still has one of the lowest levels of storage capacity in the rest of Europe. The capacity itself is significantly lower than that of its European counterparts. The UK only has less than 2 weeks worth of storage, whereas Europeans have well over 3 months worth. If the winter is cold, we can see the storage levels decline significantly, putting additional pressure on prices, which could rise exponentially, where we've seen prices rise over 20% in a single day. European storage levels are recovering, however nowhere near where they need to be in readiness for this winter, with France at 62% and Germany at 61% and Italy at 60%. Although it could be seen as comfortable for now, it's still a long way to go to get to adequate supplies this winter should any supply disruptions happen with Russia. This would be a major risk to the UK, or it's a factor to the UK, where the UK is currently exporting its gas to Europe. Right now it's working at a significant profit. However, that gas supply, it has been noted that it could be shut off and not sent to Europe to protect the UK in the future. US LNG profit by country. So we've calculated the profit of a US LNG cargo going around the world to understand where these cargoes will be. As US LNG is all private and not government owned, they will be entirely driven by price and by profit. Therefore, it's important for us to understand where is the profit for the US LNG, which will be dictating where the supply of gas will be going. As such, on this map you can see the Dutch market has the highest price of gas currently in the world. The Dutch price currently at 346 pence per therm and the UK at 220, with Japan in the middle at 237 pence per therm. These prices do change day on day with the extreme volatility, but right now the US is very incentivized to head to Europe to provide it for its gas. However, that can switch, as we saw in 2021, where they were happy to go to China because the Chinese had the highest price. That could again happen this winter, and is a significant risk for both the UK and Europe in the next 6 months. UK LNG imports declined in June and are 26% lower month on month. However, UK LNG imports remain higher than 2020 and 2021 volumes. UK LNG imports continue to be strong despite the decline in profitability for shippers due to the price premium in European markets. Nord Stream 2 still remains a question mark. The Germans are playing around with the idea of building a LNG facility in the sea, and they can connect that to Nord Stream 2 pipeline. It is an option, however, it would be costly and will take significant amount of time going forward. In summary, the Russian invasion of Ukraine has increased the potential of gas supply disruptions. Many forget that this is a war and accidents do happen, where a pipeline could accidentally or intentionally be damaged, which would impact supply significantly into Europe. The Russian supply into Europe remains curtailed and significantly lower than previous years, and this has contributed to the tightness in the European gas market. LNG supply, the UK and European prices providing LNG cargoes a financial incentive to dock at the UK and European terminals. However, the global LNG market remains tight, and the UK and Europe will always remain competing for Asia for these supplies. Storage concerns around Europe, whether it can fill its storage sites ahead of the upcoming winter, provide this winter 22 contract with additional risk premium. Our bullish views, so the Russian invasion of Ukraine continues with the supply disruptions continuing to overhang and the main threat, as well as the additional sanctions on Russian gas, but also additional fuels. We already have coal being banned on the 1st of August and the potential of diesel at the end of this year. It must also be noted that the UK, 20% of its diesel comes from Russia as well. So where that replacement oil will come from is still yet to be known. Lower booked Russian gas supplies into Europe will continue to create tightness throughout the entire market. Lower US LNG exports have been a key theme as well since the fire in early June. It is not expected till September, potentially October, till that terminal is operational and flows can begin and shipments can be sent out. However, there is pressure internally in the US of having a shut-in of gas exports. US gas prices have quadrupled over the last few months, and as such, US citizens are not happy paying such a price and are demanding that gas not be exported and kept at home in order to keep their prices down, which again would put pressure on European gas supplies. And a key theme is the storage levels, as well as weather this winter. Over the next 6 months, it's going to be key to see how warm this winter will be, but also how much storage we have as well to get through any adverse winter. The only bearish news we have if there are any easing tensions between Russia and Ukraine, as well as the rest of Europe. Should that happen, we would see the price of energy decline significantly, several pence within a matter of hours. As it has done so in December, it is more than likely to happen again. Thank you for watching this half-year review. I hope you enjoyed it. To access the detailed report, follow the links in the post.